Shopify is an e-commerce platform that allows individuals and businesses to create their own online stores. It provides a wide range of tools and services to help users sell products, manage inventory, and handle payments. The stock price is up almost 200% from its lows, but the question becomes, can it go back to its all-time high of $169 per share? This is a company that has a market cap of $111 billion that in the last 12 months has made 7.7 in revenue. From that, 1.27 was profit, which puts them at a PE of 81, which looks expensive. However, if we take a look at their financials, their revenue has grown from $1.5 billion 5 years ago to 7.7 currently. Their gross profit from $800 million to almost $4 billion. And their free cash flow has grown from $383 million to $1.29 billion with one fluke year, but overall a lot of growth. They also have fantastic margins. As you can see, gross margin has been around 50% over the past 5 years, and their free cash flow margin has been growing, again with the exception of 2022. One thing that I don't like about the company is the number of shares outstanding, which has been increasing, and this is very bad for investors as it dilutes you as a shareholder. They have an amazing balance sheet with $5 billion in cash and cash equivalents and only $2 billion in total liabilities. Then, if we take a look at what analysts are expecting, they are expected to keep growing and reach $12.9 billion in 3 years. Regarding earnings per share, they are expected to make $1.87 per share in 3 years. The fundamentals are phenomenal, and if we take a look at the revenue by segment, Merchant Solutions revenue is growing nicely at around 20% per year, and subscriptions growing even faster for the last couple of years. However, the main problem with Shopify stock is the valuation. As you can see, they are currently trading at a P of 87, a price to free cash flow of 85, and a price to sales of 14. And in order to take a deeper look at the valuation, I use my Google Sheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. As you can see, the intrinsic value according to it is between $35 and $108 per share, and the stock is currently trading at around $85. Moreover, this means that if the low assumptions occur, you're going to make a negative 4% annual return on your money, middle positive 4.5%, and high 14%. I believe my assumptions are reasonable, as I have the company growing at 18% annually on my low assumptions, 22% annual revenue growth on my middle assumptions, and 28% on my high. I assumed an average profit margin and free cash flow margin for the next 7 years of 14%, 18, and 22, and I assigned a P and price to free cash flow of 20, 22, and 24, and left the share outstanding change the same, even though they have been issuing shares. And if we assume they continue to issue shares, let's say 2% of their shares annually, the valuation becomes less attractive. Lastly, they are reporting earnings on Tuesday, and they are expected to make 27 cents per share and $2.13 billion in revenue. I believe they could beat this as they have beaten the last 3 quarters on top and bottom line. In conclusion, I believe Shopify is a fantastic company that I would like to own, but not at current prices. The price you pay for a stock will determine future results. I would love it if the stock price fell after earnings and I could possibly buy shares. But remember that this is not financial advice and you should always do your own research. I hope you found this video valuable. Let me know what you think about Shopify in the comments, and I'll see you in the next one.